Open houses quiet, days on market extended, nobody's buying, sellers are outpacing the buyers, and everybody's feeling the crunch. Today, we're going to talk about the newest headline to hit the media, Redfin. Let's talk about it. There's more sellers than there are buyers out there. After years of a tight supply and frenzied demand, the U.S. housing market is experiencing a dramatic shift in 2025. For the first time in recent memory, home sellers now outnumber buyers by a wide margin. Recent data from Redfin shows an estimated 1.9 million homes listed for sale versus only a 1.5 million buyers, meaning about 34% more sellers than buyers, roughly 500,000 more sellers in the market today. This is the largest imbalance in over a decade, unprecedented in records dating back from 2013. In practical terms, that means the power dynamic has flipped. Buyers have more leverage and competition wanes. Industry professionals and homeowners alike are witnessing the early stages of a potential buyer's market, a stark reversal from the seller-dominated frenzy of 2020 through 2022. Now, before I go on, the methodology to come up with the number of buyers is more like a guess, and the headline is really all that they were after. But there is a little bit of truth to it. So, why the sudden imbalance? A confluence of economic forces and pandemic-era legacies has reshaped housing supply and demand. High mortgage rates, affordability pressures, pandemic golden handcuffs on sellers, the lock-in effect, and record homeowner equity are all playing a role. The result is a standoff where many buyers are sitting on the sidelines and many sellers are sticking to optimistic pricing, leading to more homes lingering on the market for longer. One key driver of the cooling demand is the surge in mortgage interest rates over the past 2 years. Everybody certainly talked about it, and we're going to talk about it again. The average 30-year fixed mortgage rate now hovers around 6.7 to 7%, more than double the record lows seen during the pandemic. This jump has pushed monthly mortgage payments to all-time highs. In April 2025, the median U.S. home price sold for about $432,000, a price barely higher than a year ago, 1.6% year over year. Yet because rates are so elevated, the typical monthly payment hit a record high, illustrating how affordability has worsened despite slower price and growth. Higher borrowing costs have scared off many would-be buyers. Even though home price appreciation has cooled off to its slowest pace in 2 years, the combination of still high prices and 7% interest rate is a potent affordability squeeze. By one estimate, the income needed to afford median-priced home today is $47,000 higher than in 2019. It's no surprise then that home sales dropped to a near 30-year low in 2024 as mortgage rates climbed. In April of 2025, existing home sales were the slowest for any April since 2009. That was coming right out of the crash, reflecting how many buyers have been priced out or been discouraged altogether. The affordability crunch has created a paradox. It's technically a buyer's market in terms of supply and demand, but only buyers with enough financial flexibility can actually capitalize on it. As the Associated Press wrote, the trend is good news for home shoppers if they can afford to buy at current mortgage rates and prices. For many households, that if looms large. Before the pandemic, a middle-class income could afford a much wider selection of homes than it can today. In 2019, a household earning $75,000 a year could afford roughly half of the listings on the market. But early 2025, that same income could afford only 21% of all the homes for sale on the market. This stark drop in affordability underscores why demand has been sluggish even as more listings hit the market. Buyers are gaining negotiating power, but many are finding that the homes being offered are still beyond the reach. On the flip side of the affordability coin is the supply story. One reason inventory of homes for sale has been limited is the so-called golden handcuff effect or the lock-in effect. During 2020 and 2021, millions of homeowners locked into ultra-low mortgage rates, often under 3%. I'm sitting at 2.125%. I'm not going anywhere. Now, with the prevailing rates around 6 to 7%, those owners face a big disincentive to sell. Moving would mean giving up that 3% mortgage rate for a new loan at twice the interest rate. Understandably, many are reluctant to list their homes, effectively trapped by their cheap mortgage money. A recent Realtor.com survey found 82% of all homeowners felt locked in to their current home because of the low mortgage rate, with over half planning to wait until rates come down before selling. This rate lock effect, or golden handcuffs, has kept many would-be sellers on the sidelines, crimping the supply of fresh listings. However, there are signs this effect may be starting to ease. Life events, new jobs, growing families, etc. eventually force moves, low rates or not. By mid-2025, some owners have accepted that 6 to 7% mortgage rates are the new norm. Redfin economists note that more of these locked-in owners are now giving up these low rates and selling their homes out of necessity or changing expectations. Indeed, new listings in April 2025 rose 9% year over year. A notable increase after new supply had been subdued in 2022 and 2023. Sellers sitting on the fence seem to realize that waiting indefinitely for those 3% interest rates to return is not realistic. Even so, listing volumes remain well below pre-pandemic norms, and total inventory is still about 15 to 20% shy of the 2019 levels. In other words, the golden handcuffs are loosening, but far from broken. Another legacy of the 2020 to 2022 housing boom is the massive equity gains homeowners acquired. Home prices across the U.S. surged roughly 40% through those 2 years, reaching record highs. This run-up created a substantial equity cushion for most homeowners, a factor that profoundly shapes today's market dynamics. By the end of 2022, the average U.S. homeowner had about $270,000 in home equity, which is nearly $90,000 more than at the start of the pandemic real estate boom. Over 48% of mortgaged homes were considered equity rich. Equity rich meaning owning less than half their home's value in 2022. This widespread equity means homeowners are generally not under distress even as the market cools. Unlike 2008, when many owners owed more than their home was worth, today very few are underwater, only 2% of mortgages according to Real Estate News. If sellers can't get the price they want, most of them have the financial flexibility to wait rather than to slash those prices. They're not forced to fire sale their homes. They can sit tight on their low mortgage and sizable equity. This has contributed to a standout. Sellers flush with equity and comfortable payments aren't desperate, while buyers face budget constraints and refuse to overpay. The equity cushion also explains why foreclosures and distressed sales remain historically low. Even as the economy has seen turbulence, homeowners have tappable equity to weather it or refinance debt. In short, the 2020 to 2022 boom left homeowners in a strong position, perhaps too strong for the market's good, since it enables them to resist lowering prices. Combined with the golden handcuffs effect, these equity gains have empowered many sellers to hold out for that price. All these factors, high rates dampening demand, stubbornly low but rising supply due to reluctant yet resilient sellers, have led to a standoff between buyers and seller in 2025. Home sales have slowed to a crawl, and listings are lingering on the market longer as each side waits for the other to blink. In April, more than 44% of homes listed sat on the market for 60 plus days. That's the highest share of stale listings for an April since 2020. The median time on market for homes has stretched to about 50 days, up from 46 days a year ago. In colder months, it was even slower. 73 days median in January, a far cry from lightning one fast week sales common at the height of the boom. This rising days on market trend is a classic sign of shifting leverage. Price data further illustrates the standoff. Many sellers initially tried to price off last year's peaks only to find fewer takers in today's market. By April 2025, 18% of listings nationally had cut their asking price, the highest rate of price reductions for an April in the last 7 years. Sellers are learning that bidding wars of 2021, they're gone, and concessions, they're back. Redfin's economists observe while the market's balance of power has shifted towards buyers, a lot of sellers have yet to see or accept the writing on the wall. Many are still holding out hope that their home is the exception and will fetch top dollar. But as more homes sit without offers and traffic thins out, reality is setting in. Sellers are gradually responding by dialing back price expectations or offering incentives, i.e., paying a buyer's closing costs or points to get deals done. For now, the standoff has mainly produced a stalemate in transaction volume rather than a steep drop in prices to date. Nationwide, home prices are essentially flat to slightly up year over year. In other words, the market is cooling without crashing, a slow deflation of pandemic price frenzy. Buyers are gaining negotiating power. The ability to get an inspection, include contingencies, or buy under list price once again. But many sellers would rather wait than dramatically undercut recent comps. As one agent said, it's a buyer's market on paper, but sometimes a seller's market in practice, because affordability limits the buyer pool. This delicate dance will likely continue until either mortgage rates materially decline, bringing back more buyers, or sellers capitulate on price. In the meantime, expect longer listing times, more price chops, and hardened negotiations as each side tests the other resolve. Despite the challenges, there are a few flickers of life on the demand side heading into mid-2025. Mortgage application data suggests that some buyers are coming off the sidelines, perhaps motivated by slightly improved inventory and the hope that prices and rates won't get any worse. The Mortgage Bankers Association weekly survey in May showed purchase mortgage applications rising for several weeks in a row. In the second week of May, purchase loan applications actually jumped a whole 2% from the week prior and were up 18% higher from the same week last year. This was a notable rebound given how depressed buyer activity was in spring of 2024. MBA's chief economist noted growth in purchase applications as a bright spot, saying buyers are finding additional properties to buy, unlike the last 2 years, now that inventory is gradually improving. Government-backed FHA and VA loan applications surged even more, up 5% in a week and over 40% year over year, indicating first-time home buyers are trickling back into the market, but still make up a small portion of the overall market, much smaller than they used to. These upticks suggest that pent-up demand exists. After a year of holding back, some buyers may be adjusting their expectations to the new normal. Stable but high rates are something the market is slowly adjusting to, and with home prices no longer skyrocketing, a portion of buyers are waiting in to see if they can strike a deal. Additionally, seasonal trends are at play. The spring home buying season typically brings out more buyers, and 2025 spring has seen more activity than the especially weak spring of 2024. However, it's important to keep this into perspective. Mortgage applications remain well below pre-2020 levels, and much of the recent increase is from a low base. Refinancing activity still minimal, unsurprisingly, since few want to refinance low rates into a higher rate one. Makes total sense. And total home purchase demand is still restrained by the affordability wall. For many households, nothing has fundamentally changed yet to make buying easy. Still, the week-by-week growth in mortgage demand is a positive sign that the market is finding a new equilibrium. It also hints that if and when mortgage rates tick back down even modestly, there is a cohort of delayed buyers ready to step in. which could put a floor under how far home prices might actually sag. Georgia's housing market, particularly the metro Atlanta area, encapsulates many of the national trends playing out in 2025. Atlanta was a pandemic-era hotspot. Its relatively affordable prices, job growth, and Sun Belt popularity led to the surging demand from both local and out-of-state buyers in 2020 to 2022. Home prices in Metro Atlanta jumped sharply in that period, and inventory hit record lows as homes sold in mere days. Now, the tides are turning. Atlanta has shifted into a clear buyer's market by 2025. Redfin estimates that there are about 63% more sellers than buyers in the Atlanta metro, tipping the balance in favor of purchasers. In April, Atlanta had roughly 36,800 active sellers versus 22,600 buyers, according to Redfin's model. This places Atlanta among the more buyer-skewed large markets, though not as extreme as some places in Florida and Texas metros. Home prices in Atlanta have essentially flattened out after the boom. The median sale price in April was about $396,000, up 0.3% year over year. This follows 2 years of double-digit annual gains. The plateau suggests that Atlanta's price appreciation has hit a ceiling for now. In fact, other price metrics show Atlanta slightly down from its peak. Zillow's index recorded Atlanta's home values about 1.8 lower in 2025 versus a year prior. Resi Club's analysis similarly flagged Atlanta as seeing a modest year-over-year price decline, about 1 to 2%. Heading into 2025. The minor discrepancy with Redfin's 0.3%, which usually is used as sales prices, likely reflects timing and a mix of homes sold. But the takeaway is the same. Atlanta's price growth has stalled, and we're even seeing small dips in values in some segments, especially in some of the further out suburbs or oversupplied new construction local areas. Inventory in Georgia has been on the rise. Realtor.com data shows total listings in South region, which includes Georgia, up significantly from last year. While Georgia wasn't in the first wave of states to exceed 2019 inventory levels, it's getting closer. Builders have been active around Atlanta, adding new homes that give buyers more choices and competition for existing home sellers. Resi Club notes that the Sun Belt markets, including parts of Georgia, have an abundance of new home supply, which is contributing to the softening or resale prices. Metro Atlanta in particular has a robust home building industry. In recent years, builders have aggressively put up entry-level and move-up homes around the metropolitan fringe. This new home often comes with incentives like discounted financing or upgrades, forcing resale sellers to either match those deals or watch buyers opt for new construction. Another factor in Atlanta, the presence of institutional investors. In the early 2020s, Atlanta was a popular target for large investors and single-family rental companies. Some estimates indicated that by 2022, investors owned over 4% of Atlanta's single-family housing stock, one of the highest rates in the nation. These investors helped drive up prices during the boom by outbidding individuals. Now, many institutional buyers have pulled back due to the high financing costs and lower yield prospects. Atlanta's investor purchase activity dropped in 2023 and 2024, which removed a source of demand that had propped up the market. There's anecdotal evidence of some investors even selling off portions of their inventory, adding to supply in certain neighborhoods. This dynamic is part of why Atlanta has shifted more towards a buyer's market than some other cities with fewer investors. Despite these cooling signals, Atlanta's market isn't crashing, it's rebalancing. Homes still selling, they just take a bit longer and require the right price. The average home now spends about a month on the market, whereas 2 years ago it might have sold in under 2 weeks. Sellers who price realistically, acknowledging the market has changed, can still find buyers, especially since Atlanta remains relatively affordable compared to coastal metros. Local agents report that well-priced homes in desirable in town areas or top rated school districts do still receive multiple offers, but it's typically 2 or 3 offers after a few weeks, not 20 offers in 2 days as we saw in 2021. Meanwhile, more marginal properties, those far out or need updates, may require price cuts or incentives to move. Going forward, Georgia's outlook appears cautiously optimistic for buyers. Atlanta's strong economy, tech, film, logistics, etc., and population growth give a solid foundation for housing demand, but unless mortgage rates dip, buyers will continue to be picky and price sensitive. The era when any house would sell in a weekend, it's over. Sunbelt markets like Atlanta are now in a period of healthy correction where prices adjust to local incomes and supply catches up to the demand. For buyers in Georgia, this means more negotiating power and choice than they've had in years. For sellers, it means resetting expectation. The market is still good by historical standards, but realistic pricing is crucial to attract today's wary buyers. As we move through 2025, the U.S. housing market is poised at a turning point. The data and trends suggest that the long-awaited transition to a buyer's market, it's underway, at least in a majority of regions. Redfin's analysis already classifies 31 of the top 50 metros as buyer's market, with another 12 balanced. Prices are expected to gently decline 1% nationally, and by year end, as the imbalance of sellers versus buyers applies downward pressure, buyers in theory should have the upper hand in more negotiating going forward. We're likely to see more frequent price reductions, seller concessions, and contingent offers accepted. Phrases that were virtually extinct during the hyper seller market a few years ago. However, this emerging buyer's market comes with a big asterisk: affordability. It cannot be overstated that having leverage as a buyer is only useful if you can afford to buy it in the first place. In 2025, housing remains historically unaffordable for many Americans. Mortgage rates are expected to remain in the 6% range for the near future. Most forecasts don't see a return to 4 to 5% anytime soon, and home prices aren't likely to drop enough to fully offset that. As a result, even as prices stabilize or dip, the typical monthly payment may stay burdensome. Unless wages grow significantly or financing costs fall, the pool of active buyers could remain narrower than usual. In short, it's a buyer's market only for those buyers who qualify. This dynamic will likely keep sales volume lower than normal. We may be in a world of low volume, flat price housing market, something very different than the roaring activity of 2021. Regionally, we can expect the divergence to continue. Sunbelt markets, Phoenix, Atlanta, Austin, Tampa, etc., will probably see further softening if inventory continues to normalize, especially given many have new construction in the pipeline. High-cost West Coast markets like San Francisco or Los Angeles that cooled in 2022 and 2023 might see modest rebounds if tech incomes recover. But they too face the ceiling of affordability and remote work shifts. Midwestern and some East Coast markets could remain seller-favored a bit longer. Places like the Midwest, where inventory is still comparatively tight, may just return to normal conditions rather than an acute buyer's market. As Resi Club's data-driven outlook suggests, national inventory is on track to keep rising towards pre-pandemic levels through 2025. If that holds, more and more locales will tip in buyers' favor. Balanced markets will tip to buyers, and sellers' markets will become fewer and far between. For industry professionals, agents, brokers, lenders, this evolving landscape means adapting strategies. Agents must educate sellers that overpricing is a recipe for crickets and help buyers navigate creative financing or incentive requests. Lenders may roll out new loan products or buy-down programs to capture business as refinance volumes stay low. Home builders already offering incentives might scale back new starts in the softer markets to avoid oversupply. For consumers, the message is mixed, but hopeful. Buyers, your patience may finally be paying off. There are more homes to choose from. National inventory in April was up 30% year over year. And you're less likely to face bidding wars. You might negotiate price or repairs, options unheard of 2 years ago. Just mind your budget. Run the numbers at today's rate and, if possible, get pre-approved and lock a rate when the rate dip occurs. Sellers, the market will still reward a maintained, well-priced home. Remember that prices are not collapsing in masses, but you must be realistic and proactive. If your home isn't getting any offers in a few weeks, listen to the market feedback. Maybe that means adjusting the price or offering a perk, like paying for a year of home warranty or a mortgage rate buy down for the buyer. Those who adapt quickly to the new normal will still find success. It's like anything else. Those who cling to last year's sky-high market comps may end up chasing the market down. In conclusion, 2025 marks the beginning of a new chapter in U.S. real estate. The seller's market had a historic run, but the pendulum is swinging. A combination of higher interest rates, stretched affordability, and gradually rising inventory has given buyers more bargaining power than they've seen in years. Yet, this buyer's market is unlike the last one. For example, 2008 to 2011. It's not fueled by a foreclosure crisis or a demand collapse, but by an orderly rebalancing after an extraordinary boom. The coming months will test how smooth this rebalancing unfolds. Will sellers capitulate enough to spur more sales? Will buyers step back in greater numbers if prices dip slightly? Or will we slog along in a low activity impasse? Early signs point to a slow thaw, more inventory, slight price erosion, and creeping sales volume as the market finds its footing. Industry experts from Redfin to Resi Club agree that the power has shifted towards buyers, and we're already seeing the effects in many Sun Belt cities. For the housing sector, this is a healthy adjustment, a return to a more balanced, sane market after a frenzy. For buyers and sellers on the ground, it means recalibrating expectations. The remainder of 2025 will likely continue this trend toward equilibrium. By the end of the year, if the forecast holds, home shoppers may finally exhale a bit as prices notch down slightly and choices expand. Sellers, on the other hand, will need to embrace a more competitive environment where negotiating is back in style. The housing market's long-standing logjam is beginning to break, setting the stage for a new era where neither side dominates outright, an era where buyer's market, albeit constrained by affordability, slowly takes shape. If you saw or heard any value in today's segment, do me a favor, hit the like button, smash the follow button, subscribe, comment, and do me a favor, just remember one thing, that this entire episode, it was guaranteed.